What's up, real life trading, and welcome to your all access room in Tuesday. This is Tuesday, October 11th. Today, we're going to talk bear markets. I got this wonderful conglomeration of charts, chart patterns, bar ghost patterns going on over here that we're going to go through, talk about, and just kind of discuss and analyze to see where we may or may not be in this current bear market that we are trading. So to see where we could be is whatever standpoint you want to look at the market on, whether it's investing or some swing trades, just where you want to see. And if you want to start legging into positions long term, kind of what this could look like on a longer term basis. I know this is just the season of comparing this chart to 2008, and they are just everywhere online. And so I said, why not compare it to all the bear markets? So not all, I guess, technically. I do have to compare to some of the major bear markets out there. Bear markets technically are 20% drops, and there's a ton of those, and they're not as interesting. And we're already down at 26.24%. So we're past all those. Why compare it to something that we've already beat? So yeah, we got to go bigger. We got to go better. We got to really just see what we can do. And a lot of these are, I think a lot of these are very helpful to me just to look at, see kind of where we could be in this market. And yeah, let's just start diving into them one by one, just in chronological order, because why not? What other way is there to do it? Probably a lot, but that's how we're going to kind of go after this and look at it. And we can talk about which one of these markets are a little more possibly in the macro, in the overall data, which ones are more similar to this bear market when we're just looking at the fundamentals, and which ones are possibly a little bit more different. That's why I didn't put the 87 flash crash, or COVID isn't on here either, because we would already be to new all-time highs if this was similar to COVID crash, which it is not at all. So this is slower bear market. And how long have we actually been in this bear market is the question. It has been a total of 280 days since the peak. So I know we count like, hey, the bear market's been since we went down 20%. So it'd be like, I don't know, where's our actually 20% point? It would be right here. We went into a bear market for just about an hour and a half, and we recovered, and then we actually entered a bear market here. So yeah, depending on how you want to look at it, we are better than America. We have not made a new higher high for 280 days. So that's kind of what I'm looking at. That's how I set up all of these charts. So I just found the peak of the market. I put my peak right at about the peak. And honestly, this 37%, this 590 days, I literally just went like this. I went bang and bang, and that's how I measured it. So could they be off by a little bit here and there? Yeah, but who cares in the slightest? I don't. So I guess if you do, feel free to make this chart and go through it and see what you come up with. But we're really just looking at major trends, how long things last, where we could be, and what actually happens towards the end of bear markets, when you should start kind of looking to leg in, and some situations there. So this one doesn't really overlay a lot. And that's the interesting thing with these in TradingView. If you want to do this yourself, you can always go to the ghost feed over here. You can copy any bit of, oh, that's the wrong one. Sorry, not ghost feed. Don't listen to what I'm saying. Why did it do that? Hold on. It's this one. Bars pattern. I thought it was a ghost something. Oh well, that one's a way cooler name. So too bad it's not ghost bars. That's what it should be. Can we get a rename on this to the ghost bars? I would like that better than this. But you can just pull any bars pattern. You can edit it. You can make it so it's less visible, more visible, kind of like a ghost, like a little bit transparent, some opacity, a little less. I don't know. Ghost pattern seems cooler. I'm just saying. Now I'm off on a tangent talking about ghosts. Anyway, that's how you pull this up. That's what I did. I just basically pulled these, and I did the top to the bottom that it actually pulled back in real life back in their day. This went down 37%, so I went down 37%, and it went down 540 days out in the future from the peak, 540 days. And that's how I got all of these levels that we're going to go to. So could you do something where you just actually find each one of these and you move them and you go like, well, that's the most similar pattern right there, and that would meet with that peak, and that's how it would go. Sure, you can definitely do that. I think one of the problems with that, and why I'm not necessarily doing that in this video, at least in this session, is because you can make any bars pattern look pretty similar to another bars pattern, and then you're like, well, this is exactly what's going to happen, right? Like that lines up really, really well. And it drops more than 37%, and it happens really quick. So does that do me a lot of good? Kind of, because this is a pattern that, honestly, if we actually push up into this area at the 3900s on SPX, I will be looking to go short there personally and see if we can get a rollover of some sort. So this one makes sense. This one tells me that, hey, that is a possible pattern. But right now we're looking at kind of the distance, what happens, how much longer we might have in this bear market. And look how this line starts where all of these bear markets bottom, essentially. So we are about halfway through this bear market if it ends up being similar to any one of these 1, 2, 3, 4, 5 bear markets that we had in the past. And there's a couple others that I didn't put on here. Anything before, what is the exact date? It's like 62 or something, just shows dots. So we didn't do any work past there. It was, yeah, so 62, there it is. Yeah, so 62, it's just dots. So I didn't get any ghost bars before there, new name. So just after that, we were looking at those. So that's where everything came from, what everything's doing. So, boy, see, this is why it takes so long getting back and forth on this thing. Come on, back to present day. Here we go. All right. So that's the general gist of how I put these on the chart. If you want to do it yourself, you can also do that and look at it. But we're just looking at this first one. It's interesting to see kind of how this pattern plays out. And in 1968, you'll notice this section of it is one of the things that really sticks out in my mind on this pattern right here. Like, this is a capitulatory event. Like, we just got absolutely wrecked towards the end of this one. You'll see this as a trend in a few of these, where sometimes we do actually get that full-blown capitulation. Everyone's running for the hills. Everybody's selling. There's no one out there who wants to be a buyer in such events. And that is the time when we actually just scream lower. And in this particular one, go down approximately 25% of the 37%. Just in this last little section of it. So some of the ends of these markets, they can get very, very, very volatile, and we can have these huge capitulation events. And so that's something we can keep our eyes out for, because when we get those often will tell us, like, hey, maybe now, at least for the long-term plays, this is somewhere to possibly be buying into instead of selling the fear and selling into this capitulation. Now, huge caveat is that you need to be buying into something that you like, that you trust, that you think will not go away. Because if a stock is down 80% and you are buying it, there is nothing to say that stock cannot go down another 80%. Hashtag Peloton. So just beware that, hey, if you are buying something, make sure that, hey, if you're buying something into this kind of capitulatory event where it's just screaming straight down, remember, the trend is your friend. But if you have a longer term basis on things, I think it's good. And we are talking about some crypto later on in this hour. And that would be, if you have a long-term perspective on it, that could be something that you're looking to get into. The SPY, the Qs, some of these longer term investments, that would be where I'm looking to get in if I see something like this really come to pass on the SPX. So this one doesn't line up as well as some of the others, but we do see that if we are here, we have another 15% to go down, which would bring us down into right around the 3000s. I know that is a level on the SPX that would really meet up with a lot of really good horizontal support. We have this pre-COVID high that I think is a level that a lot of people are targeting, a lot of people are looking at, as well as like this 3200 area. I think both those levels, really solid levels. And this one kind of brings us right into that arena a little bit to say, like, hey, maybe we will go in there. So that is the 68 crash, and that one does say we got a while left in that one. So another thing that I see that some traders are doing is they feel like, hey, whenever we get one of these bounces, whenever we get this bounce right here, this big jump up here, it was 18%, and the amount of people who were like, oh man, we missed the bottom, I wish I got in all these things, it's in here. Like that, it draws people in. These bear market bounces, they suck people in, and then people are just FOMO buying into this and then just getting absolutely wrecked on these second legs down and these bigger pushes down. So we always know that, hey, we can take our time. We have so much more most likely of this market. We could just be halfway through this bear market, which means we could have another, if this one's playing out, another, how long did I just say? About 246 days. So we're almost halfway through exactly at this point. So we don't have to rush it. If we do get that bounce, if we do get that push up, if it's playing out something like this, where we're getting that push up, one, probably shorting the rip is the way to go on that piece, because this does line up really well for a nice push up into here, and then some nice new low on this. And we don't have to go to this exact level down here. We could just come down into like 3,200, 3,300, somewhere in there, and that would be a nice profitable trade. If you're getting in on a push up into the 50 or so, somewhere in there, and you're taking profits down here at 3,300 or so on SPY, or this, basically this COVID top right there, that's an amazing, that can be life-changing trade right there. So just something to remember when you're looking at these bigger charts. So let's push this back out to where it goes, and we'll look at the next date, which is 73. And I think 73 is a little bit more accurate as far as the environment we are in on a fundamental side of things. That was when we started to have big inflation. We've gone over it before, so I'm not going to dive into it too much in this exact section right now, but we have put the inflation numbers up and looked at the chart at the same time, and we can see that, yeah, it's a high inflationary time. And we, again, on this chart as well in 73, you can see it, capitulation. This is a 34% drop from that spot right there. We just absolutely sank. We capitulated. The fear was real. It was present during that time. There were no buyers. We just kind of fell off a cliff. You can see how long we kind of held on. We just bounced around. We bounced around. We held on for this right here is a number of months. I mean, this is 3 months right here that we just chopped sideways. We tried to hold on. This is where like everyone's like, hey, I think we can go higher. This, like, think about how many people were calling the bottoms in right here. Like we have this double bottom pattern coming in. We break down, we put in a low. That's a beautiful trap right here. Like, this candle is nice. We got a nice little trapping candle right there. We come up right to this level, we reject and we channel. So we had to hold this level. This had to hold. It didn't. It broke down. We retested again, and we retested again, and bang, that was it. That was the last time that we had any shot. That was when you were protecting yourself. Any breakdown of this channel after this 90 days of sideways movement, we knew that, hey, get protected on this one. So looking at these really helps us a lot too, to know, hey, where could we have protected on this move? What could we have done? And where could we be in it? So if I want to push this back, we're still about halfway through. And on this one, we're halfway down as well. If this happens to similar to the 73, we are looking at a 49%. It says it right here, over here. But yeah, just this helps some people visualize it. 49% down. Right now we are 25% down. So we are halfway done with this bear market in time and in price, if we are going to emulate the 73 crash at all, which we certainly could. I'm not saying that any of these are going to come to pass. I'm just saying studying the past really just helps you have a little bit of focus. And I will go through, I mean, if you look at it, I'll go through it all at the end, because we'll go through all the doomsday things right now and talk about just like, oh my gosh, look at the sky falling. But then we'll actually look at this, look at what happens after these crashes, and look at kind of on a longer term basis where you actually want to be buying. And I think you guys already know the answer to that if you're here watching this live or this video, either one. And it's during these times. So we pull this over. Really, this actually looks pretty close. So this is how you would line this one up. We do get, I mean, in pretty much all of these bear markets, we get these big run-ups. We get these huge traps. Like, look how on this chart, it's kind of hard to see, but you can see that we actually made a new high right here, just like we did over here. Like, we broke above this level on, it's hard to say which chart I'm looking at. So on the present day chart, we have this level that gets broken right here. We break above that level, and we get trapped. Like, this was a trapping level. This is where all the people were calling for the bottom was in. We're not going to make a new low this year. Everything's fine. Everything's great. And look what we did since, just straight down. And I know a lot of people made a lot of money on that move. It was a really good move to play bearish. And yeah, this one has a very, very, very similar thing to that as this break. Like, look at this break. This is where I can't. It's hard to see this one. Let me make it darker. How do I do that? I know which we gotta earmuffs it. It's getting scary. So here it is. So this helps a little bit. Uh, Now it's just blood red. There we go. This matches. So we do it. Look at this trap right here. Like, this is where everyone is calling for, like, oh, it's not a problem. Things are fine. Everything's good. No problems at all. We've made that new high. And we are just in a channel. If we're in this, not 73, we're not looking at the current chart, we're looking at 73 right now. We're just chopping around. We're in this channel. We reject off it. And again, we don't get as good a retest immediately right there on that level, but then we do push down pretty hard. That's a 10% push probably. Right here, we get a 10% push. We do retest that level eventually, though. That's where you're going to be getting protected. Come back down, retest that level again. We did that last time. We remember that in the 68. We had that first retest, second retest, and then we just really fall and we capitulate. So these have a lot of really good similarities between the 68 and the 73 chart. And if you do overlay them with today's chart, there's definitely some things to see that can show us what possibly we have in store for us. I'm not trying to give anyone nightmares, like we said in the chat, but we just want to be well informed of what could be happening. And these moves don't have to be to scale. That's why I don't really necessarily like pushing these all to up to here to making it all exact and being perfect. And like, here it is. It's never going to exactly follow it. So what we're just looking for is like, all right, well, if we do pop up, we push into this green line somewhere in here. Or if we even push up all the way up into somewhere in like the 200 or something, we start to fail that again, we fall and we break this level. Like, where do you protect yourself? What do you do in these scenarios? So just looking through these charts, figuring out kind of how to play them can really, really help a lot. It can help you to formulate a plan so you can keep your cool during these big, scary times if you're bullish, great times if you're bearish, right? So that is the 73 crash. Let's look at the 80 crash. And this one's interesting. So let's actually scroll back in time. Bang, bang. Oh my gosh, it's so far. Like a bajillion years ago to the 80s. Oh, no, wrong one. All right, here we are in the 80s. Here you go. 89. I was born here. So there's my birthday year, and we're going just well before then. So we got the inflation peak. That's what I'm looking for. So we have two inflation peaks back here in the 70s and 80s. The first one is back over here, kind of before we bottomed in 74, which, as I've kind of been saying, the Fed pivot, the inflation peak, that's what we're watching for in this market to happen before we can really turn things around, in my opinion. And we don't want them to go, it's a very fine line. I know Kathy Wood came out recently and said that basically the Fed was going to drive us into a deflationary bubble and everything is going to blow up. And yeah, maybe they are hiking rates a lot. Things could get pretty ugly. And so, I mean, that's why we need to be prepared for some of these things. But also the cost of them not pushing inflation down enough is kind of what happened during this period. Like this, look at the time frame of this chart right here. From this peak right here to this peak right here is 80, 73, about 7 years, right? So 2,596 days is how long that took. And we just basically did nothing. And that's because this was such a high inflation period where inflation was just pushing higher. We had a peak, then we had a low, then we had a peak, we had a low, we had a peak, we had a low. And we were just kind of moving all over in our rates and in our inflation, and we weren't able to get it under control. And really, you don't see us take off until the second peak over here, where people actually think that, hey, we actually do get under control. We got some other macro factors, some oil prices driving kind of this area, and then we actually finally see people actually have confidence that, hey, inflation has peaked. Look what we do after it. We do push higher. So that's why I think there is that fine balance between actually just crushing the Fed, just crushing the economy into the dirt and not having much left of it, and the Fed not getting inflation under control enough where we just have this long-term drawn-out inflation period that lasts so long that really nothing really moves higher. Earnings are down for companies, and we just kind of drag on the economy. So it's going to be a really fine line to walk. We'll see how it ends up. We've done some kind of crazy Fed moves in general, like they waited way too long and now they're pushing it kind of hard. So we'll see. I mean, they don't tend to nail it, you could say, and they tend to be a little bit behind the eight ball. So if they just keep hiking, and drive us into a deeper recession than we should be, it would not surprise me in the slightest, honestly. So yeah, we'll see. But yeah, so the SPX, this is an interesting one in the 80s. That's kind of what look where we are. We had this this one actually, it's interesting, right? So we chopped sideways, and this one actually only went down 28% over 622 days, right? So we were just hanging out for like 2 years long, just kind of chopping downward and sideways. And that's a frustrating market. And that kind of market, though, it can actually, we're just correcting in price as well as in time, but we're not correcting as much in price. Like we don't have to get those huge sell-offs right there of 50%, and we're able to still go higher. So if we do just correct sideways in price, or in time, I mean, over like 600, 700 days or whatever, that is possible to let us have another big, nice leg higher. And so we'll see if that happens. But this one's interesting. We do have, I mean, almost an exact parallel from this top to this bottom right here. And then it just kind of pops up, chops down, and we just see a couple new lows and new lows and new lows. Then we finally end back over here. So if we want to put this one actually over the price as well as we can, it's tough to, but it'd be probably something like that. And that one actually would lead us down to somewhere in the 37% range. And again, that's kind of where I'm looking to be a little bit more bullish, is to be buying down in this 3,300 area to this 3,000 on the SPX. I think being a little bit more aggressive buying down there is what I'm planning on doing. Just because a lot of this data shows that, hey, if you're for buying long-term positions, for short-term day trading, I mean, honestly, just none of this matters too much, right? But like says, so all signs point towards markets getting wrecked. It's sort of the theme of this video. Yes, you picked up. I think that's a spoiler. There's still two more things. So sorry. Yeah, spoiler alert. Just go to the end of this video if you want to see that all signs point towards markets getting wrecked, from Hector. But yeah, so I mean, right down in this area, that one really just makes a lot of sense down there. Not the housing market though, says Woodshed. We won't spoiler alert that one either, but hashtag 2022, all things get wrecked. So here we go. Yeah, this one's really interesting chart. I like it. And yeah, well, this one would almost be more painful for a lot of people if we don't really go down, because we have so many people. I mean, think how many people were just buying this fear right here. They were just buying puts on this fear. They were just freaking out. They spent all their money in their account that was left on puts. We got that bounce. Then we came down again. They go, oh, fine. They finally bought puts. We broke this low. We went lower for like a day and a half. They went, and then we went back up. We go low. We break this low again. It's just pain after pain after pain on this chart right here for the people who are just kind of selling the bottoms and buying the tops. And so this is a painful market. You can see all the people getting trapped. You can see all the fear. You can see all the pain happening on this chart. And just the fact that you're moving sideways, you don't get that capitulation that we get in one of these events where it's just like, bang, done. We did it. Fine. We just went from, in a span of 3 months, we just crash, we go down, and we just call it a day, like on the 73 market. Like, yeah, it's painful. So many people are getting wiped out. But it kind of gets it over with. It kind of cleans the system up quickly, whereas this one just kind of chops sideways for so long. All right, so let's dive into then we needed the 73 and the 80 crashes during that inflation time. Like, both of these happened. So could we get some kind of thing where we're in kind of this big longer term secular bear market where we actually come down, we make a low like 3,400, then we see a new high kind of barely chop around in here, and then we see another new low sometime. Yeah, I think that's possible especially if we don't get inflation under control. We kind of just have this longer time bear market the last 5-6 years, where in it, yeah, if you actually came down to 33,000, then you came back up, you would have this 60% run inside that market. but it would still not be really like pushing and trending into just a new longer term bear market. And so obviously there's lots of gains to be made in any market if you're knowing how to trade, but it's not just going to like hit that bottom and just be a new bottom for the market and just bounce about it. We might just have if inflation just is persistent on us and just plaguing the economy and the market, that is a possibility of us making this low, popping up, and then making another low sometime later on in the next few years. I think that's worst case scenario for me, if I'm being honest. That would suck. I'm not wanting that one to happen, so hopefully it doesn't. All right, so the most recent ones, most everyone here was around for the 2000 crash and the 2008 crash, even if you were just a wee little baby during those for 2000 especially. But yeah, so here's the 2000 crash, and it's interesting. Again, we have that capitulation event, and I actually put a little more data on here. Matt said I was still on AOL. Yeah, on 2000. Yeah, that was. I wish I could find those stocks, those charts. Heck says I wasn't born yet, and it was just such a young thing. So the all those tech stocks. It's interesting to look at them. And it's like you can't find the charts, and I think there's going to be a lot of companies like that in the. We'll think of the 2000 bubble and the 2020 bubble as very similar in a way that so many stocks went up just thousands of percent, and now they're gone. And so I think that's definitely going to happen to some stocks out there. So got to be careful what you're in. But this it's similar. It's a gnarly market. It went down 50% in 680 days. And that's this first one right here. If you actually go to where it basically makes another low over here, that's 912 days right here. So that's a little bit of time. And it's definitely going to be hard on the people if we just kind of bounce around it here. And this is the thing too about trying to time market bottoms is we're pushing down on this thing. We're just crashing down. Yeah, we're going to be like, maybe we can see that there's a bottom down in here. But I think a lot of people were just waiting for this thing to break down again. And they were like, well, this is it. And this was the bottom right here. This is the bottom, and we went just up there to 2008 top. And a 2008 top, again, like if you look at it, like I was talking about with that, the 70s and the 80s, if you actually scroll up and look at this, I got to go weekly, hold on. If you scroll up and look at this on a bigger time frame, this 2000, and then we can come down, we come back up, and we come down. I mean, this is a very similar chart. It's kind of like this correction flat pattern that we're seeing right here, and we're just seeing like just barely new high, and then we crash again, we come down, we make new low. Very similar kind of to this pattern down here where it's a little different, but the kind of the extent of what is going to happen during it is the same, where we're just kind of chopping around this area. We make this low, we make this high, and then finally we're able to after this breakdown to get that sell to get that. Finally, we get that push right there. So yeah, there it is. SPY selling off a little bit. Nice, good job if you're in short. All right, so let's go back to all the way up here. Yeah, so up here we can go through one last one. And yeah, 2000. I think we're probably, if we wanted to put this in like the quote unquote right section, we're probably in this area somewhere. So again, a lot of these are in an area where, hey, we might be bouncing at some point here and then falling. Like if you actually put the well, we have a little ways to fall in this one first. So this could be like the capitulation event right here. If we get like just a terrible print on CPI on Thursday, we just really run down. That would basically be a retest of the bottom of the 200 if we did something like that. And then we rolled over back down into whatever level we're going to come back down into on SPY. So possible that could definitely happen on that one. So drag this to right there. All right, then the last one we have to look at is 2008. 2008 is really, I think a lot of the comparisons to 2008 are happening because, it's tracking so well. Like we do look very similar to this 2008 pattern. It's kind of exact. And again, I just put this on from top to bottom. This is how far out it should go. So it's not like I'm stretching this one, trying to be like, well, let's make this exact perfect. Like, it's this is it. This is how it would exact same put on as the others. So we'll see. We'll see if we do get this kind of month-long, 2-month-long bounce, and then we kind of do get that capitulation at the end there. We actually did get kind of two more legs down on this one. So we got to push up. We moved sideways for a long time. We got final, just like everyone's just like, nah, this is it. We got a final 20% push towards the bottom where we just were getting absolutely just wrecked. Everyone was feeling it, so sad. And yeah, it was hard times for sure in that sell-off right there. So that is the 2008. We're tracking very, very well, but we really have to push up now. We need to push up and get to maybe like 3,800, somewhere in there on SPX, for us to kind of be following this one still really well. If we just kind of do breakdown and retest, we're kind of be diverging from it, but it'll be very similar to kind of the patterns we're seeing. If we kind of put them all together, what could happen. So I have plans for whatever happens either way, but my bias for the short term at least is short. So I am looking to get in some short positions. If we do bounce, if we do kind of break down, I'm already in some short positions. And if we get that retest, I'll be getting into more short positions. So just kind of playing the S curve on these things, watching how it plays out. But I don't know. I thought this was interesting looking at all these. And the real interesting thing to me is just the fact that, hey, we do have, if it's going to play out like this, like another 200 days, which basically we're halfway through kind of what this is going to turn into. So we're in October right now. Just going to push us into early to mid 2023, and then I think that time frame lines up really well with kind of how the Fed will act, how we'll actually see the bottom come in at some point. But if you want to kind of find for your longer term investments, I would say you don't have to be rushing into anything, because I think we definitely have time on them to be getting into them over a period of the next 6 to 12 months or so, kind of legging into them, because you can see that after every single one of these, we did have some really nice moves after 2000. When we finally did bottom, and say you bought some of your long-term stuff and you were just legging in this whole way down, it took you a while to possibly be profitable on this one. And again, this was kind of that time frame where it looks like we have the kind of big expanding flat kind of bear market time period where we're just coming down, we're coming back up, we're coming down. And so we didn't make huge gains after this, but after 2008 crash, I mean, obviously everyone knows the story from that. It just goes like that. And then on the 70s crash, again, we didn't make some huge gains, but decent gains. We actually didn't hit a new low after 74. And after the 80 crash, we really saw some big gains. So if you were going to be getting into long-term positions, I think those would kind of be your favorite times to do it. Any of these corrections, you would say, hey, I want to actually be buying. I would be buying into this rather than panic selling. So it's kind of the good news of it is like, this isn't, if you do have long-term things, that if there are in actual good companies that are going to be around for the long term, those should be doing well in a number of years. So if you have that time period and you have that time, I would say just try not to get too depressed, try not to capitulate at the bottom with kind of the rest of everyone, and just be selling this bottom. And I think in a number of years, we'll look back, and I think wherever we kind of bottom out on this, 5 years from now, we'll look at this as, hey, this was a pretty good buying opportunity. All right. So that is kind of it for me for this. But yeah, it looks like we got about another year to half a year left. So just be protecting whatever capital that you have out there. Be ready to deploy it. Be deploying it slowly if you want to, but just know your risk. Be monitoring that risk at all times. And yeah, that's kind of what I got for you today. So let me stop this recording, and I will see you all next time.